Okay, let's work a problem where we have an asset that we purchase, and then after we purchase, we choose to sell it. In this case, we're selling it before its useful life is up. So let's take this step by step. First, we know that on February 1st of 2017, we bought some equipment, some machinery for $500,000. It has a 5-year usable life, so if you do some quick back of the envelope here, it's 500,000 divided by 5. That's how much depreciation you'll take at year end if you have a full year, 12 months. Its residual value, it's worth about $10,000 at the conclusion of 5 years. We're going to assume straight line depreciation, which is great news when you're working with this type of stuff. And now assume that on February 1st, 2019, we sold it for $17,000. So the question is, what's the gain or loss on this sale? Let's take this piece by piece. Let's start at the beginning with February 1st, 2017. February the 1st, 2017, we purchased this for $500,000. So here we have our cash leaving the corporation. We have machinery coming in. I want to make you aware of the fact that on the day you buy something, it has a net book value, right? Even if you have not taken depreciation, that doesn't mean net book value doesn't exist. Net book value just happens to be $500,000 what you paid for it because you have not taken any depreciation yet. Remember, we take depreciation, we make a depreciation entry either at year end or when we sell the asset, on the day that we sell the asset right before. So let's go ahead and fast forward to 12/31/17. You'll notice this purchase happened 2/1/2017. Let's go ahead just to make sure. Let's remember how many months there are between February the 1st and December 31st. January is 1 month, and then you begin February on February the 1st. So if you count with your fingers, I'll give you a chance to count. You have 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. That's 11 months. So from 2/1 to 12/31 is 11 months. So on 12/31, let's 2/1 to 12/31. On 12/31, we'll make a depreciation entry. But note, we're not making one for 100,000. We're not making one for 500,000 divided by 5, because that would be for a full 12 months. We're taking 500,000 divided by 5 years. That's its usable life. Excuse me, its usable life. And then I've kind of simplified it here. We're multiplying by 11 months. That's the number of months that elapsed between 2/1/2017 and 12/31/2017, and divide by 12. So basically, we're multiplying by 11/12. I just kind of detail it here so you see what we're doing. Transiting 11 months, dividing by 12. And that gives us depreciation expense of 91667 rounded, and accumulated depreciation of the same. Now, with this entry at year end, we've updated depreciation, and here's an update of what we have in net book value. The original 500,000, you notice now we've taken depreciation, and we have less net book value. Let's fast forward to 12/31/2018, which I think you will enjoy because it's so simple. Now we're taking a full year's. Now we're taking, at the end of the year, 500,000 divided again by 5 years. But notice, again, I tried to make it a little cartoony here. Times 12 divided by 12. So now we're taking a full year's worth of depreciation. Here you see an update to net book value after this entry is made. And you will notice that now we have the first year's depreciation in there of 91667. Remember this? 91667. And we have the second year's, which is a full 100,000. It gives us a net book value of 308,333. So now remember, we're going to sell this 2/1/2019. So when we're going to sell an asset, one of the first things you want to do is update depreciation. Get depreciation updated to the date of the sale. Well, the date of the sale, remember we made an entry, we made this entry 12/31/2018. So how much time elapses between 12/31/2018 and February 1st of the next year, 2019? Well, if you look carefully, it's just 1 month. From 12/31/2018 to 2/1/2019, it's just 1 month. It's the month of January. So pretty easy. We take 500,000 divided once again by the 5-year life. That brings it into per year amount times 1 month, right? divided by 12 months. Again, you're taking 1/12 of 1 year's depreciation. I delineate the months here so you can see exactly where this stuff's coming from. Original historical cost divided by 5 times 1 month. That's how much time elapses from 12/31 to 2/1 divided by 12 months. There's our depreciation. Now we've updated depreciation, so we're ready to go ahead and engage in the sale. So we engage in the sale. Before we get there, updated net book value as of the date of the sale. You'll notice, again, $500,000. Now we have 3 years worth. We have the first year, we have the second year, which was a full year, and the last year, which is just 1 month. You'll carefully note if you add this to this, remember this year, the first year, we took 11 months worth of depreciation. The last year, this one, we've only taken 1 before we sold the asset. You notice this plus this happens to be 100,000, which would be a full year's. 11 months, 1 month. I mean, that's just a curiosity, so you notice the relationship in the numbers. That gives us a net book value of 300,000. Now it's pretty easy. For right now, just ignore this. Don't worry about the loss on sale. Don't worry about a gain on sale. Let's just take everything off the books. First, we get our cash entry right. $17,000 is what we said we collected back here. So there's cash coming into the company. And then we're going to get the asset off the books. The asset is on the books at $500,000. Remember this entry? This will stay on the books forever if we don't take it off. So we've got to take this off the books. The cash we really have and it's ours, but the machinery is disappearing. So there's the machinery going off the books. Let's take these one by one. Ooh, that's too dark. That's the machinery off the books. Here's the cash coming into the company. We don't take accumulated depreciation off the books. What we take is the very latest amount of accumulated depreciation. Okay, so don't just go back here and go, this is what's in the accumulated depreciation account, 191,667. Part of the reason you make this entry and update depreciation is so you know what the latest version of this is as of the date of the sale. You'll notice 91,667, 833, and 100,000 is 200,000. So we take this off the books. Notice too that accumulated depreciation is a credit when we make our entry at the end of the year. It's a credit. It's a contra asset. Basically, the net book value on the balance sheet, it would show 500,000, and then it would say minus accumulated depreciation of 200,000. So this is a contra asset that sits with the credit balance. So we debit it out, and then we just take the difference. And the difference in this case happens to be a loss of 283,000. So this is an example of an asset we bought that we got very, very little for, and for some reason that's unrelated to the accounting here, we don't have to talk about it, we chose to sell a little bit early. You notice that the thing lasts 5 years, but we didn't get 5 years out of it. So maybe we had maintenance problems, maybe this should have been good till 2022. Yeah, 2022, and we sold it here early on 2019. This is an example of the entries. I wanted to show you going through every single piece here where we put the asset on the books, where we take a partial year's depreciation of 11 months, where we take a full year's of 12 months, and then where we update it for 1 more month to bring it up to the purchase date, the sale date, and this is the ending result. This is going to the income statement because it's a loss. This is going to the balance sheet because it's an asset. This is a contra account on the balance sheet account, and it comes off, and this is an asset on the balance sheet. I just want to go through this. I hope you find this useful.